Hello and welcome to Brownfield's weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, you didn't get kidnapped, did you?
No, didn't get kidnapped. Mizzou's on spring break this week, and so um, took a little time off here over the week just to kind of recoup and recharge.
Well, there you go. We won't get specifics on your location. It looks like you're hid away somewhere that looks calming and fun, hopefully. So
Deep in the woods.
deep in the woods. Well, looking at commodity prices this week, we saw a general, bullish trend, a general rise within the market. Starting with that May corn crop, that was flat at 436. December corn up 3 cents at 473. May soybeans up 14 cents at 1201. November soybeans up 12 cents at 1192. Soybean oil on a cents per pound basis for May were generally flat at 48.71. Soybean meal by the short ton was up $7.50 at 333 or excuse me 339.40. That nearby wheat contract up 9 cents at 551. July wheat up 9 at 567. And then crude oil for June was flat at 81.49. So Ben, a lot of light gains, but still a lot of gains.
Yeah, right there in the middle, that soybean market up 12 and 14 cents, depending on which month you're looking at there. That's really representative of the trade starting to expect smaller soybean acres or soybeans giving up some acres to corn, given how warm it's been. We'll get to that here in just a few minutes, but that's kind of what's led some of that rally right there in the middle.
Well, and at least it's a general positive. We've been struggling to see too many silver linings within the market over the past, several months here, but it sounds or it seems like we're finding at least, some footing for maybe at least a hold, if not some gains here moving forward. But Ben, we have several big topics to talk about coming up today, some things internally and some things externally. So we're going to start talking about the Federal Reserve today. Uh, as per their last meeting, it doesn't look like interest rate cuts are coming anytime within the near future. What's your read on the situation and what's your outlook looking at what the Federal Reserve is planning to do?
Yeah, so the Federal Reserve kept their short-term interest rates flat at 5.25 to 5.5%. However, probably the biggest news was that they went and doubled down on their notion that they would have three interest rate cuts still in 2024. That's what they said, last month. Many people in the market had thought that they would start pulling back from that harsh, kind of dovish language, if you will, from the standpoint that, we had seen some market expectations come in hotter than, I shouldn't even say market expectations. We'd seen some market data come in hotter than what was anticipated, or even the month before. That led many in the trade to assume that we'd start to see the Fed walk back those three interest rate hikes. They did not. They doubled down that we'd still see not hikes, that we'd see three interest rate cuts. Instead, they doubled down on that. And as a result, we saw the stock market, the Dow Jones, we saw them set records multiple days in a row. And we haven't had that for a long time.
Well, and Ben, looking back over the extended period of the increase in these interest rates, the Fed really did follow what they signaled they were going to do, over that course of time. And we're in a unique position now to where maybe things haven't, the pressures haven't moved away from those inflated pressures, haven't moved down as quickly as the Fed would have thought or hoped. So do you still expect them to kind of follow through and still follow exactly what they signal?
Yeah, so you are right. The Fed did exactly what they said they were going to do for the better part of the last 2 years. Now they're telling us that they're going to have three interest rate cuts. The market is believing them, that we're going to have three interest rate cuts, which is converse of what we've seen the last 2 years, where they didn't believe that the Fed would continue to increase rates, and then they did. So this is an interesting time, and that was signaled by, again, the stock market just really shooting up last week after the announcement or the press conference by the Federal Reserve. I have a hard time believing that they can maintain this position of three interest rate cuts. I continue to think that inflation is going to become a problem again later this summer, and that the Fed is going to have to hold interest rates where they're at, if not even maybe thinking about increasing interest rates again. Now that's me, I guess, taking a different stance than the Federal Reserve is at. We also got their quarterly updates of their forecast for the year. I found it interesting that even though they maintained their position of three interest rate cuts, They are forecasting lower unemployment rates than what they were in December and higher inflation than what they were in December. Both of those factors moving opposite of where they would like to, or at least their expectations. But again, they maintained and doubled down on that philosophy of 3 interest rate cuts in 2024. I think that's going to be hard. And given how strongly the market reacted, I think that's going to build consumer confidence once again. And we're going to see inflation creep back into the economy.
Yeah. Well, Ben, we could spend all day talking about the Fed, but I want to switch over to some internal things that FAPRI is doing. For those of you who don't know, Ben Brown is working for and with FAPRI at the University of Missouri, and FAPRI does an excellent job putting out a lot of estimates, a lot of outlooks, and a lot of economic models on what farm incomes and different outlooks could look like moving forward. And Ben, some of your recent reports that are getting ready to come out, they're signaling maybe some of that farm income is dipping, maybe some pressures are kind of approaching the market here. So breaking it down, I guess, commodity by commodity, starting with corn, what's the FAPRI expectation when it comes to looking at corn acreage and different things like that?
Sure. So, just for our viewers and listeners to understand, so we do policy analysis and we do that based on baselines. And so every year in the spring, we produce a 10-year baseline book that includes our kind of estimates, if you will, of markets and policies for the next 10 years. We know things are going to change and influence those. Primarily, we hold policies constant during that period. We know that that's probably not going to be the case. But it does provide us a baseline to then shock for different scenarios and do some analysis with. So we released that already the middle of March. And so, we have our forecast out there for the next 10 years, knowing, again, that things will change and that these will be adapted as more is known, as weather unfolds, as policies change. So to your specific question about corn, we continue to see a decrease in corn acres in 2024 relative to 2023. We're a little lower than where I think the industry average is at the moment at 90.1 million acres. With a trendline corn yield, that produces a expected corn production of almost 15 billion bushels. That's slightly down, or that's down almost 4 million bushels from where we were in 2023. Again, smaller acreage being the biggest reduction there. We do see demand increasing to help, I guess, use some of that large supplies. It's largely driven by corn exports being a big part of the growth and demand for that picture. However, the bottom line here is we expect the season average price for 2024 to be about $4.39 per bushel. That's down from an average of $4.78 per bushel last year. And we expect to see another decrease in price in 2025.
Well, Ben, over the last few weeks, we've talked about, the short-term economics of corn versus soybeans and acreage and how that picture might be shaping up. But FAPRI is looking at again, that expected reduction of 4.5 million corn acres. But it's also seeing an expected 4.6 million acre increase for soybeans. Talk about what that means for the short-term outlook for soybeans.
Yeah, so this is largely driven by profitability. Again, we just see stronger returns in the soybean market relative to the corn market. And these are very stark differences here, anywhere between $100 to $150 per acre difference between soybeans to corn. We feel that that's going to bid in some soybean acres. However, as I continue to mention, it has been dry here in the month of February and March, leading us to maybe think, and I think the trade to think that maybe we'll see a little bit higher corn acreage when this is all said and done relative to where we expect. But we do see profitability pulling some soybean acres in at the expense of corn and maybe some other crops. That soybean picture increases as well as corn, or similar to the corn market, a higher production due to increased acres. We do see domestic crush continue to increase. We have it up 116 million bushels this year to support our growing renewable diesel industry. The bottom line here is the season average prices for this year, 2024 and 2025, at $10.73 per bushel. That's well below, almost $2 per bushel lower than what we experienced in 23 and 24 of $12.68 a bushel. And we anticipate that price decline to continue into 25 and 26, again, due to excess supplies and growing ending stocks.
So Ben, looking at this season, if you had to put a headline on expected gross farm incomes, what would that headline be as compared to last year?
Well, farm income is kind of an interesting thing because that includes a number of factors, including government payments. But I would say that we see declining prices and higher production for certain parts of or higher sales for certain parts of the country. I remind you that Missouri and the Western Corn Belt, didn't have as much product to sell last year due to the drought, but we had large government program payments, namely crop insurance, that kind of flooded in as well. So I would say overall, we will see declining farm income due to these lower prices, lower government payments as well. That's going to deteriorate some farm working capital, and outside weather, macroeconomic conditions, or changes in policy. Right, that's kind of the other thing. There is we're assuming that the current farm.
Yep.
What?
Can't stress the policy changes enough.
That's right. We are going to see a period of tight farm margins that's going to lead to probably a little bit of farm consolidation out there at certain points as we get down the road. So.
All right. Well, Ben, we went from long term to, kind of the middle term. Now let's look at the immediate short term on reports coming up this Thursday. Some big reports from USDA. We have prospective plantings. We have grain stocks. Ben, what are your expectations for these reports and how they might shake things up?
Yeah, so let's start with the grain stocks one. That one's always a really interesting one here in March because it basically represents the first half of the market. I mean, it does. It does represent the first half of the marketing year for demand for corn and soybeans. The first half of the year for corn is a huge demand driver given how much we feed during the winter months. But I look at these corn stock numbers and I anticipate, an increase of 1 billion bushels in corn stocks for March 1 relative to where we sat last year. A sizable increase in soybean ending stocks, getting to the higher end of our soybean stock average. I remind our viewers that 2018 and 2019 was a huge soybean stocks number because we were dealing with that trade conflict with China. And so that kind of throws our averages off a little bit, but or at least our perception of what's a big soybean stock. But we have soybeans to ship here out of the United States or to use out of the United States. And so I do think that we see a large ending stocks or March 1 stocks number for corn, soybeans. Wheat, a slight increase year over year, and wheat ending stocks, we'll have to see where that one comes out. That one's a little bit tricky given some of the cancellations we've seen lately. And then on the plantings report, and this is probably the one that is going to generate the most headlines because there's quite a bit of uncertainty out there in terms of what's actually going to happen in these acreage numbers. But USDA in February estimated 91 billion acres of corn. I told you we're not that far off in our FAPRI forecast or FAPRI estimate for the year. However, we did ours in January. I think things have changed a little bit since then, given the warm weather. The trade is anticipating 91.8 million acres of corn. So that's up, almost 800,000 acres relative to where USDA was in February. Conversely, the soybean picture is down almost a million acres. Down. I don't know why I'm struggling with this so much. I'm looking at a whole bunch of numbers here. Corn is up 700,000 acres relative to where USDA was in February. Soybeans is down 1 million acres relative to where USDA was in February. Again, that's why we've seen a little bit of the price rally this week that we saw in the soybean complex is because of the expectation of lower acres and lower production in tightening ending stocks.
All right, Ben. Well, looking forward and rounding out this week, what should farmers and ranchers be paying attention to outside of those two reports?
Well, Thursday's the big day. Thursday's the big day when we get grain stocks and prospective plantings report. Those have a tendency to move the market big time, limits up, limits down some years. Outside of that, when we turn the calendar to next Monday, so Monday after the Easter holiday is the first of the month. And so we have a lot of the beginning of the month reports like grain crushing, fats and oils, and then also our first crop progress of the year. So we can get an idea of how quickly planting has started here in the United States.
All right. Well, Ben, it's always a pleasure to have your knowledge on the program. Viewers, listeners, if you'd like to learn more about us and what we do or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.